What is happening this week in crypto? Markets crashed harder than anyone expected. Institutions quietly launched new products while retail panicked. Asia made a massive move that barely anyone is talking about, and Bitcoin and Ethereum started showing signs of life again. Let's break down the 5 events that happened this week and what they actually mean. 21Shares just launched its first US crypto index ETF. Yes, the same company behind some of the largest European crypto ETPs finally entered the US with something regulators avoided for years: diversified crypto index fund. According to some reporting, 21Shares launched 2 index-based ETFs for US investors designed to track a basket of major crypto assets instead of just Bitcoin or Ethereum. Here's why that matters. Investors can now buy broad crypto exposure through one product. It introduces a new S&P 500 style structure to crypto investing, something institutions understand. It signals that regulators are finally relaxing on multi-asset crypto products. But critics argue this comes at the worst time, in the middle of a crash, and that early inflows will be tiny. Still, the move is official. The US now has its first crypto index ETFs on the market. So the question becomes, will this pull fresh institutional money, or is it too late in the cycle? Singapore just launched regulated perpetual crypto futures. This one barely made it to Western headlines, but it's huge. According to Business Times reporting, the Singapore exchange rolled out regulated perpetual futures for major crypto assets, open to institutional accredited and expert investors. Here's why it matters. Until now, perpetuals were dominated by offshore platforms like Binance, Bybit, or BitMEX. This is the first time a major traditional exchange in Asia is offering preps in a regulated framework. It gives hedge funds and big allocators in Asia a compliant way to take leverage crypto positions. In simple terms, Asia just opened the door to institutional leverage legally. This could shift liquidity away from offshore ventures into regulated Asian markets. But the risk: regulated preps could amplify volatility if adoption accelerates faster than expected. So the real question is Singapore positioning itself as the next global crypto derivatives hub? Binance CEO responds to the crash: this volatility is normal. While crypto retail was melting down over the sudden double-digit crash, Binance CEO Richard Peng went on record via a Reuters interview with a completely different take. His message was simple: relax, this is normal. According to his interview, Bitcoin's recent swings are in line with other major asset classes. The sell-off was driven by macro uncertainty, not structural damage. He described the movement as part of a broader risk-off shift across markets. This directly contradicts the panic narrative circulating on social media. The interesting part is that Binance has internal trading data that the public doesn't see, meaning this may be the first big insider level signal that the market is still functioning normally beneath the panic. Still, the pushback is obvious. If volatility is normal, why did altcoins crash 40 to 60% in a week? So here's the real takeaway: either Binance sees signs of stability before anyone else, or they're trying to calm a market that still looks fragile. Bitcoin hits a 7-month low as ETF outflows hit record levels. This was the headline that shook the entire week. Bitcoin briefly fell below $81,000, the lowest level in roughly 7 months. US spot Bitcoin ETFs saw roughly a $3.7 billion in redemption in November, the highest monthly outflow since launch. Altcoins were hit even harder, many dropping 40 to 60% throughout the week. Analysts pointed to forced liquidations, macro uncertainty, and institutional de-risking as the primary triggers. This wasn't a regulated correction, this was a full-scale deleveraging event. A few important points: market makers reduced risk exposure, ETF issued reported sharp redemption spikes, on-chain and derivatives data showed panic selling from leveraged traders. Firms with large Bitcoin treasuries also came under pressure, with analysts warning that prolonged price weakness could force some to sell to shore up liquidity. Here's the dynamic most headlines didn't highlight. Different institutions reacted differently. Some reduced exposures aggressively, while others took small positions during the dip. This split behavior is important. Some institutions are exiting, others are positioning for long-term accumulation. So the real question becomes, is this the end of the bull cycle or the start of a long accumulation phase? Bitcoin and Ethereum show earlier recovery. After the brutal sell-off, major assets finally showed signs of stabilizing. Bitcoin bounced back into the $88,000 to $91,000 range. Ethereum jumped roughly 4% and held key support levels. Analysts describe the current state as a consolidation phase, a balance between buyers and sellers. Liquidity began to improve across major order books. Volatility cooled down compared to early week levels. In plain terms, the bleeding slowed down. Is it a real trend reversal? Not yet. but it does indicate the crash may have been a liquidation event rather than a structural collapse. This gives long-term investors room to breathe, but short-term traders still need to be more careful. This week wasn't just another round of red candles, panic selling, and dramatic headlines. It revealed 5 structural signals that matter far more than the volatility itself, signals that shows where the market might actually be heading once the dust settles. The launch of new investments products in the middle of a market meltdown is not normal behavior in traditional finance. Typically, companies delay launches when sentiment is terrible. They wait for stability, for investor appetite, or for a market rebound. But here we saw the opposite. Institutional players are pushing forward despite chaos. Why? Because product development cycles in regulated finance aren't short-term reactions. They're long-term strategic plays. Singapore move wasn't just another product release. It signaled something deeper. Asia is no longer content being the secondary liquidity hub behind the US and Europe. It wants to lead. Launching regulated perpetual futures, not offshore, not gray zone, but fully regulated, is a massive step in that direction. This matters because derivatives drive liquidity. Whoever controls derivatives flow controls price discovery. Binance messaging suggests stability behind the scenes. Binance didn't tell people to buy the dip. They didn't claim the market is bullish. They didn't deny the crash. Instead, they said something subtle but important. This volatility is macro-driven and in line with major asset classes. Whether people like Binance or not, they have access to more internal trading data, liquidity flow, user positioning, and order book depth than anyone else in this industry. Record outflows are scary on the surface. Billions leaving the ecosystem in a single month looks like the end of a cycle. But historically, the worst ETF outflows tend to happen after the price has already dropped, when sentiment is at its lowest, right before markets hit a reset point. This is classic late-stage capitulation behavior. It doesn't guarantee a bottom, nothing does, but it's a strong signal that the panic is reaching exhaustion. Institutions that were overexposed are exiting, retail that was over-leveraged is wiped out, and forced sellers has already been forced. Bitcoin and Ethereum are starting to stabilize. This doesn't mean the bull market is returning next week. It doesn't mean that the bottom is confirmed. It doesn't mean volatility is over. But the early signs of stabilization, higher lows, reduced liquidation, slower volatility, improving order books, tell us something important. Liquidity is returning and buyers are willing to step in. After a true capitulation event, markets typically enter 3 stages. The shock phase, massive selling, long liquidations, panic. Stabilization phase, volatility cools, markets find footing, and accumulation phase, smart money buys quietly before the crowd returns. Right now, we're somewhere between stage 1 and stage 2, slowly moving into stage 3. That alone is a signal. The real question is this: are we watching the early formation of a new accumulation phase, the kind that looks boring today but becomes obvious in hindsight? Or is this just a temporary relief bounce before one final flush low? That's it for today's video. Subscribe for more.